Coming back to earlier points about globalization.
Good morning, ladies and gentlemen. I'm placing an order to sell short euro at 117750. Order placed to sell short at 11775. Okay. At the same time, I am opening position for Japanese yen, long position at, no, it's too late, sorry. It's too late. I wanted to place a long on Japanese yen. Let's wait what's going to happen later with Japanese yen. But with euro, order still on. Let's see what's happened.
Invest. That's the kind of the carrot that the bond market is providing to governments.
Piers, thank you very much for joining us. Piers Hillier, Royal London Asset Management CEO. And Piers will be continuing his conversation with us here at Bloomberg. And Matt and I move over to radio at 9 a.m. UK time. You'll find us and Piers there this morning. Coming up here on the European Market Open, though, energizing the electric vehicle market. We've talked about Tesla. What about Nikola? It secures a $2 billion deal with General Motors. Our interview with the startup's chairman and founder. That's next. This is Bloomberg.
Position open short for euro at 117.75.
Welcome back to the European Market Open this Wednesday morning, 21 minutes into a session that sees European equity markets up by 0.5%, despite fears around the tech sell-off in the United States. NASDAQ futures point to the upside. Now, Tesla suffered its biggest one-day drop ever after the electric car maker missed out on being included in the S&P 500 index, taking some investors by surprise. Shares closed down 21%, shaving $82 billion from its valuation. We've already had investor response to that on the program. Now, declines worsened when General Motors announced it's taking a $2 billion equity stake in the electric truck maker Nikola. The no-cash deal broadens GM's bet on alternative energy vehicles while providing Nikola with a much-needed dose of credibility. The startup's founder, Trevor Milton, spoke to Bloomberg.
It's actually a great, really good deal for both parties. Probably the most important thing about this is that, one, we're able to get an OEM with some of the best supply chain in the world that can instantly build our Nikola Badger with a factory that already exists. The hard part for that is it takes billions to build a factory, and it takes decades to learn the supply chains the right way. The second thing that they bring to us really is the ability to leverage their batteries and their other parts bin. So that would be like their parts supply. The batteries alone are going to save Nikola over $4 billion over the life of this agreement with us. So even just from the batteries alone, we've already doubled our what we exchanged in-kind services. We gave up about $2 billion worth of stock. We gained over $1 billion in savings on the batteries alone. Their battery costs are 30% less than ours. So it's a huge huge advantage there, along with the access of everything else. I mean, imagine just having one of the best teams in the world to manufacture your truck for you.
Yeah.
Honestly, just couldn't wish for anything better.
So Trevor, obviously a lot of comparisons are drawn between your company and Tesla, obviously because of the name and obviously because you're both in the electric vehicle industry. But your approach here to manufacturing is obviously a lot different than the approach Tesla took. And of course, you also have, I guess, these sort of ancillary businesses with regards to hydrogen and else. How does the partnership specifically with regard to GM, is that going to allow you, I guess, to sidestep maybe some of the challenges and pitfalls that Tesla went through in trying to sort of ramp up its own production of its various vehicles?
Yeah, right or wrong, we just took a totally different approach than Tesla did. I mean, Tesla had access to an immense amount of capital. They've spent tens of billions of dollars. So they could kind of do things on their own. We knew going into this when we started that there was no way to raise that kind of capital immediately. It was really important for us to be able to build these relationships. So people like Iveco in Europe for our big semi-trucks, we really focus on the big semi-trucks. That's where our company came from. And we've got over 10 billion in pre-orders for those trucks that are waiting to be built. Margins are huge. They're really good. But the problem was we knew we couldn't do it alone. So we partnered with Iveco to do it. And then here for the Badger, we did the same thing with GM. And what this allows us to do is save billions on the factory. It allows us to get to market fast, enter a supply chain that already exists. And for the Badger, it allows us to be competitive against the biggest, everybody in the world. We're going to have a truck out in a year and a half in production. That's incredible.
So with regards to actual sales or potential sales down the road once this is out there, what types of volumes are you hoping to sort of reach in the short term, say within the first year or so of production?
Yeah, I think we have to be careful not to run too fast, right? We've seen this and I use Tesla kind of as a good understanding because they've been through a lot of problems and they've learned from them. When the Model Y came out, there was a tremendous amount of problems with paint and having issues coming off the factory line. We can go build as many trucks as we want. The problem is, can you service them? Can you warranty them? Can you make your customers happy? Mm-hmm. We're not looking to build 500,000 trucks a year. We just don't want to do that. We want to focus on a small quantity that is very profitable and make it an item that just everyone wants, and there might not be enough supply of it, right? We're not trying to build 500,000 a year.
How about sales and servicing? Is that going to be owned by Nikola, or is that something driven by GM?
Yeah, directly through Nikola. That's one of the things we learned. When we sat down with GM, we said, look, the world's changing, and we don't think the existing way of doing things is the right way. It's probably a blend. So Tesla does everything themselves. We don't do everything. We just do some of it. And so we think that direct-to-consumer for the sales definitely is important for us, and we have that right. We're the ones in charge of that. Also, we're probably going to partner with someone on warranty. That may be GM, it may be someone else, but we're going to partner with someone on warranty because we want a nationwide infrastructure immediately.
What about states, though, like Texas, where you can't do direct-to-consumer in that way, but that's a big truck market?
It is, but there's a lot of ways. There's a lot of ways to handle that. They've already figured that out with, Tesla's figured a lot of those out. Some of them are distributed outside, brought in. There's a lot of ways. We believe that Texas and these other states are going to ultimately allow you to, if you're doing service with them, we believe they're going to allow you to work with them. So it's just a little bit of legislation, and in the next year and a half, we'll have those pretty much all figured out.
That was Trevor Milton, the founder of Nikola, speaking with Bloomberg.
Welcome back to the European Market Open at 30 minutes into today's trading session. We've got European equity markets trading higher, up by 0.5% in the aggregate. And looking at where the gains are coming through, we see some of the best performance in Germany, up 0.7% on the Xetra DAX right now. In terms of sectors, there really is one sector that's moving more to the downside than others, and that is travel and leisure. When you dive in, it's pretty broad-based, really, in terms of the selling. We see Ryanair down by 2.9%, IAG down 4.5%, Lufthansa down 3%, some of the hotels down 2% or so. So some concerns possibly jumping off the potential for delay in a vaccine, and maybe that is weighing on that particular sector. To the upside, we see utilities, personal and household goods, and some of the more defensives like telecoms, healthcare moving higher. Let's get a Bloomberg First Word News update. For that, here's Laura Wright.
Thanks, Anna. AstraZeneca has paused a late-stage trial of its coronavirus vaccine after a participant became ill. The drug maker said the decision was a routine action intended to allow researchers to examine safely data, but it could delay or derail efforts to deliver the so-called Oxford vaccine, which is seen as one of the leading candidates to provide immunization against COVID-19. Boris Johnson is set to tighten lockdown rules in England. All social gatherings of more than 6 people will be banned as of Monday, down from the current limit of 30. Police will have new powers to disperse and fine any offenders. High-yield bond defaults could double as companies struggle with the economic downturn. That's according to Double Line Capital CEO Jeffrey Gundlach. He criticized the Fed's emergency actions, accusing them of buoying asset prices and spurring unsustainable corporate borrowing binges, and warned it would be foolhardy to think the economic shock could be a healer by a one-shot deal from the Treasury. Deutsche Bank says the best run for stocks and bonds in 160 years is coming to an end. The bank's research team cites big shifts in the political economy, from worsening social equality to a reversal in globalization, heralding what they call a new age of disorder. Combined equity and debt prices across 15 developed markets hit their highest level since at least the 1860s this year. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna, Matt.
Laura, thanks very much. Laura right there in London with your First Word News. Now, Netflix has more than 190 million subscribers, but where does the company go next as the streaming wars heat up and the pandemic disrupts production? The co-founder and co-CEO, Reed Hastings, spoke with Bloomberg about those issues, as well as the company's unusual leadership setup.
It's really dependent on the two people. It is an unusual situation. But if you think of every family, they're generally two CEOs running the family, and you just have to be really close. And Ted and I, again, have been together for more than 20 years, and with the two of us, I'm totally confident it'll work great.
The pandemic, in many ways, has played right into Netflix's hands. You're in a perfect position for this moment. That said, production has come to a halt. Projects are backing up. I'm not complaining, but it's getting a little harder to find something new to watch every night. How do you think the entertainment industry looks different when it emerges from this?
Well, it's definitely a challenge from the lack of production, particularly in the U.S. In Europe, we're able to go back to production, and in much of Asia. But in the U.S., it's still quite slow and challenging. And that's going to have an effect more next year than this year, not only for us, but for our competitors also. But everyone's figuring out how to make it work, just like if there's a writer's strike or other things that have happened over the last, 50 years. And so in the long term, I think COVID is just a little blip and a historical footnote, kind of like the 1918 pandemic that we read about today.
You said that there is a space for many streaming services in the market. I know you've been impressed by what Disney has accomplished. We've just seen HBO Max launch anew. How many of these services, though, do you think actually have the potential to reach 100 million or 500 million people? And will there be consolidation, and who's left standing?
There's a huge difference between Disney Plus, which is over 60 million subscribers in the first year, and HBO Max, which is 3 or 4 million. So one of those is like really incredible. I would not have guessed you could get to 60+ million in the first year. But, we'll see depending on what the quality of the services are. I do think over time there'll be additional consolidation like Fox Disney, which has proven to be great for Disney. But there'll be probably some more of that because consumers want, fewer brands, that give a wide range of entertainment rather than too many.
So how many years of growth are left before Netflix has to think about something new? And what might that be? I mean, would you be open to a big acquisition, video games, social media?
We always try to keep an open mind. My first company, we acquired a lot of companies, and so we've kind of been through that, not, afraid of it. It's got some good and bad properties, but mostly we want to make our service better. And there's, at least 5, 10, 15, 20 years of growth, really focused on making our service better and better. And we've always added new types of programming, for example, starting in series and then expanding into film and nonfiction and now animation. So we'll just continue to expand in what we offer in the service.
That was the Netflix co-founder and co-CEO Reed Hastings. And you'll hear more from the man behind Netflix today at 9 p.m. in New York, 7 p.m. tomorrow in Hong Kong and London. He joins Carlyle co-founder David Rubenstein in the latest episode of The David Rubenstein Show, Peer-to-Peer Conversations. That could be really interesting. Now, the pandemic is plunging the world economy into recession, forcing central banks and governments to race to the rescue. Stimulus plans totaling trillions of dollars across major economies have been crafted to prop up businesses and support the swelling ranks of unemployed workers. But there are concerns a cohort of zombie companies could be created. Joining us now with his perspective, Bernd Spalt, the CEO of Erste Group. Good morning to you, Bernd. Lots to discuss then in terms of the European banking scene. I wonder if you could give us your thoughts, though, on whether we are creating zombie companies. When you look at the companies that you've lent to or the sector has lent to during these tough times, is this a concern for you?
Well, I do think that first, if we look into our region, which has entered the crisis from a position of strength, with strong government and with strong also public households. So all of these countries have been able to help and give liquidity support in this time. Now, clearly, as the economy is falling throughout the world, if you pour in liquidity slash leverage, clearly at some stage, solvency ratios will hit rock bottom. So I think what has been done so far was a good response to the crisis, a firm and rigid response to the crisis, but it's really now about taking the next steps. How can we strengthen corporate balance sheets who are now under pressure because of falling turnovers, because of falling profitability, and in a context where we see in our region economies already picking up again, sort of demand building up. I think now it's vitally important that we also create a capital market situation where companies get access to equity financing.
Have you seen then, and I mean, your biggest markets, Bernd, are in Central and Eastern Europe. Have you seen an acceleration of bankruptcies in those markets, or do you expect us to see that in the last quarter of this year?
We have not seen any kind of increases in insolvency rates. We have not seen yet any kind of increases of delinquencies. And this is clear for two reasons. One, the governments implemented very quickly a moratoria for both private as well as for corporate segments. So people who chose not to repay could sort of pause with the installment repayments. So liquidity was eased, was softened, and also the government guaranteed loans which were provided bridged a situation where the economy was put to a halt. Now, do I expect insolvencies to rise this year? I don't think significantly, but I do think as all of these developments will have a lagging impact on corporate balance sheets, we will see probably next year as the year where we will see insolvencies rise, where we'll also see probably unemployment becoming more permanent. But still, I think...
do you think, though, that loan loss provisions at the bank have peaked, Bernd? Do you think loan loss provisions have peaked? I think you thought so in the second quarter.
Yes, I do think that what we have done is we did everything we could to build provisions for the increase in insolvencies, which we expect in 2021. So we intended and we did front load as much provisions as we could so as not to kick the can down the road.
You know, you've said in the past that you think, I believe you said you think governments should be investing not only in company debt, but also in equity, which makes sense and is something that we haven't really seen governments really get closer to. What do you think banks like Erste can do in that sense?
I think playing a very important role in a context where equity needs to be brokered to companies whose balance sheet needs to be strengthened. I think government's role is not only in participating in equity contributions, but much rather in creating an environment where it's attractive to invest into companies. So creating a tax situation which is more attractive for investors, and creating a situation where also retail investors find it more easily to invest So I think this is something where the whole capital market environment needs to be strengthened, where capital market financing needs to be at a level playing field with bank debt financing. And so far,
can
the
I ask
banks,
you about dividends,
our,
Bernd? Obviously, the EC.
I'm placing a stop on profit for euro at 117.73. Stop on profit at 117.73.
From the ECB, and what does it mean for the ban in the future? Do you think the ECB should now lift the ban?
We have postponed our annual General Assembly, which was planned to be for May, before ECB has come up with any kind of recommendation. And with that decision, we also postponed our decision on our proposal to pay a dividend, because we said at the beginning of the year when the crisis broke out that as long as there's little visibility on how the recovery out of this crisis will work, is not the proper time to pay a dividend. And we have said at that time, we want to take that decision in the fourth quarter of this year, at a time when we believed that there would be more visibility of the recovery shape. We think now we do have a lot more visibility now. We intend to hold our AGM in 2020, at the end of 2020. We have been very profitable in 2019. We have been profitable in 2020, and we see our economies in all of our countries recovering already. So I think there's every justification to pay a dividend for both 2019 and 2020. But clearly, we also will not act against the recommendation of the ECB.
Bernd, it's great to get your take. I don't think we get a look enough at the central and eastern parts of Europe, and it's really a key part of really the economic engine for all of us. Bernd Spalt, CEO of Erste Group, thanks so much. Hope you can come back and spend some more time with us in the future. Coming up, the ECB. Speaking of, the ECB's emergency QE program could be undercutting the bloc's green goals. What can the central bank do to incorporate climate change into its agenda? This is Bloomberg.
I close position on euro at 117.73. I have a profit £200.
Welcome back to the European market open. 46 minutes into a trading day that shows some upside for European equity markets. The London market, the FTSE 100 up by more than 1% right now. NASDAQ futures actually up by 1.5%. So have we drawn a line in the tech sell-off? We'll see. Now, the ECB's emergency QE program might be undercutting the bloc's climate goals. Environmental campaigners Reclaim Finance say that the purchase of bonds from Shell, Total and Engie is feeding into a natural gas frenzy. Joining us now is James Purcell, Quintet Private Bank Group Head of ESG Sustainability and Impact Investing. It's an interesting question, isn't it, James? What the ECB, what central banks should be buying, how should they be choosing between one bond from one company and another bond from another company? Does this go to the heart of one of the big questions for ESG around how to define sustainability and where natural gas fits in there? I guess that's something that many people struggle with.
So I think what we're dealing with here is what is the mandate of the ECB? And the mandate of the ECB, of course, is to maintain market neutrality and to ensure that a functioning financial system. I don't actually believe they should be tilting their purchases towards green assets. If you think about green bonds, economically, they hold the same credit risk as their conventional counterparts, and it wouldn't be a great thing to do to actually distort that market.
What are you seeing in terms of private investment then to try and help the ESG cause? I mean, how much has this trend grown?
I think it's fair to say that the trend has really exploded in recent years, and it's a reflection, of course, of the world outside our window, whether it's consumer trends and what people are purchasing, or, of course, some of the climate protests and so forth. I think the big change, though, really here is about it moving from being that 10 to 15% of the private clients who were true believers, and now we're really engaging the mass middle, as it were. Call it another 70% or so of the population. And they're very keen, of course, to invest sustainably if the rationale is robust, if the thematic is engaging, and, of course, most importantly, if the returns are attractive.
That's interesting. So moving away from sort of preaching to the converted, but to the others as well. James, let me ask you about the possibility of political change in the United States later on, well, in November, in a couple of months' time. What will that bring, do you think, for the ESG community?
This is a complete game changer, potentially, depending on how the election falls out. If you look at what the Trump administration has done, it's rolled back around 100 pieces of environmental regulation since it came into power. And fairly straightforward, if you see another 4 years of Trump, you will see further deregulation. That, of course, will increase short-term profits for many companies, but potentially actually increase some of the governance risk as well. The counterpoint, I think, is really around who benefits from a Trump victory most of all. It's probably more the marginal producers in carbon-intensive industries rather than the mega caps. You take one of the recent examples when he was repealing legislation around methane leakage. You actually had the majors coming out against that, even though it would have been profit positive for them. And that's a big sea change in how companies are interacting with the administration.
You say that Germany could be kind of the Silicon Valley of green technology. Why is that, James?
So when we think about how the green wave is developing, it's really about technology, it's really about enablement. And if we look across Europe, we really have to turn our focus to the Mittelstand. It's been a region that has reinvented itself many times over multiple decades and really does hold a dominant force in engineering topics. So while spiritually the green momentum is probably being led out of France, I think the solution providers really are Germany. We've got to remember, of course, that Europe in general missed the last big wave, which of course was the tech wave. This could actually be Europe's opportunity to get on the next wave.
James, thanks so much for joining us. James Purcell there from Quintet Private Bank Group. He's the head of ESG, and I'd love to get you back and do some more of this, James. So hopefully we can make another appointment with you. Coming up, stocks struggle for traction in the wake of Wall Street's big sell-off. Is the tech drop a healthy correction or a bigger rout? We put that question to Tomoko Yamatsaki from our MLive team next. This is Bloomberg. Welcome back to the European Open. We are almost an hour into the session, and we're looking now at 1% gains on the FTSE. The DAX almost up there, 115 points. The CAC 40 gaining as well. So European stocks rise up after the drop that we saw yesterday. I want to get into the markets now with Tomoko Yamataki from our MLive team. And Tomoko, I'm not sure if I just noticed it or if you've been doing this Europe piece in the MLive blog for a while. I saw it yesterday. I thought it was a great addition. So really glad to get you on the program. Let's kick it off with the MLive question of the day. I'm always fascinated to know what Bloomberg clients are responding as far as our QOTD. Today you're asking, is this tech drop a healthy correction or a rout? What are you hearing?
That's right. Right. So, well, let me just start that. I'm more of a bear. So, with this unstoppable rally we've been seeing in global technology stocks, I would say it was only a matter of time that we saw some pullback. Most voices I heard this morning were saying just it's a healthy correction. But given the sort of paradigm shifts we've been seeing over the years with various innovation and technology industry, the bulls are actually arguing that there is still room for upside given their growth prospects. So that's one thing to watch out for.
Interesting. Good morning to you, Tomoko. And interesting to see that the Nasdaq futures are now up by 1.4%. So we'll watch that one. We haven't mentioned oil prices much this morning on the program, and they've been down below $40 a barrel in the Asian session, now back up at 40.33. But what was behind the drop then we saw in Asia?
Right, and I would add to that oil drop has been one of the reasons why there was some sort of a risk-off move at some point. Oil has been rising futures volume, and that's pointing to some fresh shorts apparently. That's coming after some price consolidation that we saw earlier. Now, a few of my colleagues are also noting that demand remains quite weak, and it's still, if you look at it, it's far from returning to pre-pandemic levels. Another thing to note in terms of general risk-off is the whole hard exit scenario in the UK. It's way underpriced in markets. And my colleague was noting that if it was, the pound would be sub 120. So it's worth noting that.
What are, Tomoko, some of the other key assets that we should be watching right now?
Right. So to gauge the sentiment, I'd really say it's worth keeping an eye out for bonds and gold. If we've yet to see the kind of frantic buying of those havens as we saw, say, back in March. And if you do start to see them,
I'm going to have to wrap you there, Tomoko. Thanks so much for joining us, Tomoko Yamataki.